What's up, everyone? Welcome back to another episode of the E-commerce Influence Podcast. My name is Austin Brawner, and I am excited to bring you this episode today. I've been thinking a lot about cryptocurrencies, decentralized finance, doing some exploration, and I wanted to bring you guys an episode, part of a series on cryptocurrencies, decentralized finance, NFTs, all the craziness that's going on. So this episode is with my good friend, Nat Eliason. Nat's been on the podcast multiple times, mostly for his work around SEO and building a company called Growth Machine. But recently, over the last year, he has made a trajectory shift and moved into the space of Web3 and specifically decentralized finance. In this episode, Nat talks all about why he got excited about it, what's important around decentralized finance, and why, as a business owner, you should care about it. As a business owner, and also just as a investor, you should care about it. We go through some of the basics around DeFi, how people are getting hedge fund style returns in this space. We talk about how to get things set up, some simple ways to start earning money on your cryptocurrency if you do have some cryptocurrency, and what he expects coming down the pipe. It's a really interesting episode. I would recommend, if you're listening to it and you're struggling to follow along, to watch the YouTube video, because Nat does some screen sharing and shows you some different services and places that you can go and park your cryptocurrency and actually get paid for leaving it there. So this episode, I want to think of it as like a 101 / 102 episode, because there are some aspects of this space that are challenging to understand without understanding the lingo and the language. So I'm doing my best here. I hope you guys enjoy this episode and get a lot out of it. I had a ton of fun recording it. I hope you guys enjoy it. Let's kick this thing off. All right, Nat. Welcome to the show, man. Excited to have you.
Good to be back. Is this number 3?
I think it's number 3 or maybe number 4. I'm not sure. I believe you might be my most recurring guest. And I always love having you on the show because I always learn something from you. And you're a very curious guy, and you're always exploring new things and learning them and sharing them. It's one of your gifts for sure.
Thanks, man.
So I'm excited to have you back on the show because, one, since you've been on the show, every time previously, you've kind of been like, Nat here to talk about SEO.
Yeah.
And you've made some big transitions because you decided at one point that you didn't want to talk about SEO anymore. And so you've made some changes. Tell us a little bit about what changes have been made since last time we spoke.
Since last time, obviously I was running my content marketing agency Growth Machine, and that was obviously going really, really well, and decided that it was at the point where it didn't need me as much as it did in the early days. And Nora, our new CEO, was like way more than capable of running it and probably doing an even better job than I could with where the business was at that point. And so last December, promoted her to CEO, and she took over and has been running the business, and it's been awesome. Like, it's still growing, still like doing all the content marketing and SEO stuff that we were doing before, and she's been running with it. And I kind of stepped out to figure out what I wanted to focus on next, which led me into crypto, DeFi, and now I'm like a full-time programmer. So pretty big change from doing SEO and content marketing, but it's been a lot of fun.
And when you first made the transition, you had said you retired. And you retired from Growth Machine. But I know behind the scenes, you've been actively, after a little bit of time off, actively trying to figure out what kind of the next step was for you, the next thing that you were interested in, to be able to kind of take your creative energy and put it towards. And you mentioned you kind of landed on cryptocurrency, decentralized finance. First of all, what is DeFi? And why did you get so excited about this after checking? I mean, you tried a couple of different things. You're looking into real estate. But yeah, why DeFi, and why did you get so excited about this?
Yeah, so I first got excited about crypto back really like 2016, 2017. I've got a couple of old articles on my blog from that era. Just, I thought the space was really neat and seemed like it had a lot of potential for some cool stuff to happen. But there wasn't very much going on yet. Like there was sort of the promise of stuff that could be going on, but a lot of it had not that much had been, really developed yet. So I kind of like left that then and ended up doing growth machine and content marketing and everything. And then with this newfound free time, I said, okay, well, what's kind of like interesting for me to explore now. And like you said, I looked at doing commercial real estate stuff. I tried to do the YouTube stuff for a little bit. Neither of them seemed like really great fits. And then what stood out to me was like finance is interesting, or finance is this weird thing where it is kind of like boring and mathy and spreadsheets. And, for anybody who's running a business listening to this, or even just, for personal finance stuff, like it's very often not a super sexy thing to do. And if you're super into it, awesome. But for a lot of people, it's not that exciting of an area, but it's also incredibly powerful in the sense that if you are really good with finance, and if you do understand like sort of all the ins and outs of personal finance, business finance, whatever, it's a massive competitive advantage. It means that you can do a lot more with your money. You can make your money go a lot further. You can be a lot more protected from unexpected events. There's just like, it's this huge force multiplier for like life and business that is often hard to get excited about, but there is stuff that can be exciting, right? Like, credit card churning or like frequent flyer rewards is like one example of where like personal finance could be kind of fun and exciting. And, one thing that has always like, I think been, a downside of personal finance and like individual financial optimization is just the lack of options and the lack of clarity, in the sense that there are all of these kind of incredible financial instruments and things you can do to be creative with your money if you're ultra wealthy. But for the average consumer, you don't have access to any of those, and you can't use your money in a lot of the same creative ways that a lot of like really wealthy people can. And what I kind of saw going on in decentralized finance was really like re-architecting and democratizing access to financial instruments in a way that, one, really leveled the playing field in the sense that individuals with small amounts of capital could get access to, comparable returns on investment as like the best VC firms, and also reducing the kind of like rent-seeking middlemen that it feels like have taken over a lot of the gains in finance right now, right? Like you look at any of these massive Wall Street banks or whatever, and I'm not like super anti-Wall Street or whatnot, but the amount of money they make without really like really like making that much stuff always seemed a little kind of absurd. And most of it is, it's sort of like rent-seeking, like charging fees on helping people get access to stuff, whatever, management. And it's a great business for them. But if you can get access to the same stuff that you historically needed to go through them to get access to, and you can access it without giving them, 20% of your upside or whatnot, like that seems pretty good to me. So
for sure.
It was, a combination of like seeing all of those opportunities for significantly more interesting personal finance options, as well as kind of like cutting out these middlemen and providing an interesting hedge and alternative to what's going on in like the US money market with like insane amounts of like printing dollars and, inflation that may or may not be transitory. It all kind of like it came together to create this super, super interesting, compelling future that really immediately sucked me in. And then with how fast the space moves with new things coming out like daily or weekly, it's a pretty easy rabbit hole to fall down. And then, you pretty quickly end up just like being completely immersed in the space. And, that's where I ended up.
Kind of, and learning incredibly rapidly. I think one of the things that you brought up is, these banks taking fees and, at the end of the day, asking ourselves, like, what are they actually doing to make a lot of this money? And it's interesting. I don't know where I read this or heard this, but it was in the saying that if you want to tell what a society values, look at the largest buildings. Whatever the largest buildings that they create, that's where they value. That's what they value the most, right? And if you look at like Europe in the past, it was churches, right? Beautiful, incredible churches. What are our largest buildings? Almost unanimously, every single large building is going to be finance, and it has been that way for a long time. So it makes sense too that when this change happens, like that's the largest, most valued thing in our society, and this is a change that's happening in that space. So there's potential for incredible amounts of change. One of those things you mentioned, I want to come back to, is you mentioned financial instruments or types of investments that previously only people of incredibly high net worth are able to access. What are some examples of things that you've saw in DeFi that you recognize as, oh, wow, this is something that previously you could not access these types of returns, but now you can?
Yeah, well, I mean, one really simple example would be basically like getting hedge fund style returns on money deposits. And actually, maybe I'll just go ahead and share my screen. Is that cool?
Yeah, for sure. And if you're listening to the audio podcast, there's a YouTube version where Nat's going to go through and share a screen and talk about some of this stuff.
I'll try to explain it in case you're not watching online too. But it's like, this is just like a simple example, and this is a site called Yearn. And Yearn is kind of cool because they're kind of like a decentralized hedge fund. Mm-hmm. So what they do is you can deposit funds with them, like a stable coin, like USDC, and then they'll go put it to work, earning the highest return on it possible across all of the like various options that you have in like DeFi and crypto. And so if we pull up just an example here, like this is their USDC vault where you could deposit USDC, which is a stable coin that's pegged to the value of the dollar. And, this is currently earning about 7% APY, which is, sort of like a good average year in the stock market, right? So nothing crazy, but the difference is this isn't like a basket of stocks. It's just like dollars. So this doesn't like fluctuate up and down. It just goes up. So your return might go, might be lower some weeks, might be higher other weeks, but if it's netting out to about 7%, then you can just like put US dollars in here and take them out. It's kind of like a 7% interest savings account would probably be like the closer analogy to, the type of thing you're used to.
If we think about the returns you get in a savings account today, it's laughable.
Exactly.
Especially with inflation being at 5%, over 5%, 5.5% this year. So just because I want to clarify something for people who are listening, what is a stablecoin?
Yeah, so a stablecoin can be one of a few things. It is, on its simplest level, a stablecoin is a crypto asset that is pegged to the value of typically it's a real world currency. So the most common stable coins are going to be pegged to the US dollar. The US dollar has sort of become the unofficial standard of measurement in crypto. And you see a lot of the top
and that's Tether,
coins.
Right? Tether and USD. So are they both connected to the US dollar?
Exactly. So Tether is pegged to the US dollar, USDC is pegged to the US dollar, DAI, Binance USDC. There's a lot of them. And actually that was, one of the other things I was going to point out on like Yearn is if you wanted to be a little more creative, you could say, okay, well, of all of the coins pegged to the US dollar, which one is earning the highest yield on average? And that's currently this one called MIM, where you can deposit your USD pegged MIM and it's earning 22.5% interest right now. Right? Like that's an incredible year in the stock market, and it's just earning that without putting money into growth stocks or whatnot.
Well, speaking on that, right? So what is the downside for this? What's the risk that you're taking with a stable coin like MIM here that would give you 22%?
Yeah. So the risk is kind of like we could put it in three buckets. So one is the underlying risk that comes with doing anything in crypto and DeFi. And usually that's going to be on the Ethereum ecosystem, but it might be on the Solana ecosystem, might be on the Terra ecosystem, wherever you're doing it. There's always going to be some underlying protocol level risk, right? So just as an example, Solana had an issue a few weeks ago where the entire blockchain was down for 20 hours, right?
So you wouldn't be able to deposit and wouldn't be able to withdraw.
Exactly. Now, I mean, granted, banks are down all weekend and whatever, right? But it's a little scary when the entire network securing billions of dollars of funds like goes down for a day. There's never been a protocol level failure that kind of like endangers everything, but obviously it doesn't mean it can't happen, right? Like it is possible that there is some, massive vulnerability we don't know about with Ethereum that, it could get hacked and like everything could just like go up in smoke. And I'll talk about some ways you can actually hedge against that later. But so that's like the base layer of risk you're accepting. And to me, I feel like that's just been fairly minimized at this point from the fact that there's about $200 billion worth of value in DeFi now. And that honeypot has been just like getting bigger and bigger over the last year or two. And a lot of the smartest developers in the world are like full-time trying to hack Ethereum and like DeFi stuff. And they succeed occasionally. You hear about these like $50 and $100 million hacks every now and then. So you got to be careful with new protocols. But the odds of like the Ethereum layer getting hacked seem low. Then you've got like the Yearn risk. And so Yearn is this platform that is going out and farming this yield for you. And so they could have a bug in their code and, they could get hacked and you could lose funds that way.
And in that way, the funds would it be that they get hacked because when you're depositing your funds with them, it's transferring out of your wallet, right? And we'll go to the wallet a little bit, transferring out of your wallet and going into theirs. Is that correct?
Correct. So
if they get hacked, you could potentially lose your Ethereum.
Right. Yeah, your Ethereum or your USDC or whatever you deposited with them.
Sure.
So you're trusting them to not get hacked. And, again, it comes down to this like, okay, how long have they been around? How much auditing has been done on them? How battle tested is all of this stuff. I think Yearn is probably like one of the most battle tested platforms in the ecosystem. And so that's why you see people who are using like large amounts of money often prefer it because sure, you could probably get like 30% on your MIM if you were like doing it more actively on another platform, but Yearn just like handles everything for you. And that's why there's $120 million in this like one deposited section. And then the third layer of risk is just like individual fuck ups. Like you might lose your seed phrase for your wallet, or like you could lose your MetaMask seed phrase, or you could like accidentally expose it and somebody could like break into your account and take all your money, and there's no support line, right? Like there's nobody you can call to get your Ethereum wallet access reinstored, right? If your Chase account gets hacked, you've got some like FDIC insurance and you've got people you can call at Chase to help you out. You don't have any of that in crypto. Like this happened to me earlier this year where I was like getting sloppy with programming and basically let somebody hack my wallet and they stole like 30 grand from me. So like not super fun event. So you do have those levels of risk too.
I want to come back to one thing, the stablecoins, but I want to ask a question here. So you said MetaMask, and seed phrase, which if we're talking about from like a 101 perspective, what is a MetaMask and what is your seed phrase? What is it? Not what is your seed phrase, but what is a seed phrase?
Apple, banana, dog. And those are good questions. Keep bringing me back to the 101 stuff because I get excited and get ahead of myself.
Yeah.
So most people are probably familiar with like buying crypto on Coinbase or, Robinhood or whatever. And when you are using Coinbase or whatnot, you don't really own your crypto. The closest analogy might be that if you are buying stocks through Schwab or whatever, like they're probably not mailing you your physical stock certificates, right?
Sure.
And so you're trusting them to accurately represent how much stock you hold and to reimburse you for that stock and everything. With crypto, it's the same way.
I kind of think of it like
Coinbase,
gold. Like when you buy
yeah,
gold and you use one of these services, they'll often hold the gold for you. And okay, at the end of the day, if shit goes wild, they still are holding the gold.
yep, yeah. It's not the same as having the gold like in your bedroom closet.
Yeah.
So with crypto, it's the same way. Coinbase, Robinhood, Kraken, Gemini, whatever, they all are called like custodial wallets or custodial. Yeah, I guess like custodial wallet's the most accurate term. Or basically, you can log in with an email and password and all the stuff you're familiar with, and they say you have this much crypto, but you don't really have that crypto. They have the crypto, and you can like sell it or buy more of it or whatever. But you can also transfer it out. And transferring it out means sending it into a crypto wallet that you control. And there are a lot of versions of this. You can get super hardcore, and you can have what's called a paper wallet, where it's literally just like a piece of paper with your full seed phrase on it and your public key, and you have to like manually type it in whenever you want to use it. That would be like, the ultra secure version, although also like kind of risky because if you like lose that piece of paper or something
Or a fire or something.
Yeah, or a fire or whatnot, right? It's not necessarily a better solution, but one kind of like middle ground a lot of people use is an app called MetaMask. And this is specifically for Ethereum and Ethereum ecosystem crypto interactions. And basically you can just add MetaMask to your browser, and then it creates a wallet for you that you can send crypto into. So if I like share my screen again here, you can see that while I'm like doing stuff on my computer here, I can just like click this little MetaMask thing and I can see like, okay, I've got 0.1 ETH in my wallet here. And that just means that if I wanted to go do something in DeFi right now, I only have about 0.11 ETH at my disposal to go like do stuff with.
Sure.
So
and instantly, because otherwise you need to transfer into that account to be able to use it.
Otherwise, I'd have to send some in from Coinbase, or I'd have to take it out of one of the places that I have it deposited in the DeFi world. And so this just like gives you, this basically lets you go do anything in DeFi.
Sure.
So just if we were doing like a really simple example, we can go to a site like Aave. Aave is like one of my favorite like crypto tools, like favorite DeFi tools, DeFi protocols, because it's really, really simple to understand in the sense that Aave is a lending and borrowing platform that's completely automated and completely decentralized. So you can deposit money or you can deposit crypto into Aave and earn interest on it. And then you can borrow crypto from Aave using the amount you've deposited as collateral and accrue interest that you owe on the amount that you've borrowed. So this is really neat because, if you're like, let's say that you just wanted to park some of your stable coins in a place where you don't want to deal with urine, you just want to put them somewhere simpler. Like Aave is a really good option because they're like a base level protocol. So you're only trusting Aave. They have, I think like 25 billion in total assets under management across the like various chains that they're on, Ethereum, Polygon, and Avalanche. And so they've been holding up to $25 billion in assets for like over a year now. So, really, really battle tested, very secure in that sense. And you can still earn pretty good interest rates, right? Like, I mean,
here, what I'm seeing on this USD coin is like 7% if you deposit it.
Plus another 1.5% in bonus rewards from Aave. So yeah, you're earning 9% on USD coin right now.
And that's just for parking it there. Do you have to leave it there for any significant period of time, or you just
No. You put it in, and basically within seconds you see it accumulating. So I can actually show you, right? Like if we just watch this number, you can see my interest accumulating by the second. And so
why, to answer, that's the big obvious question. Why are they doing this, and how are they making money? Is this a liquidity pool, or what exactly is going on here?
Yes. So it's not a liquidity pool. It's not a decentralized exchange. It's purely a lending and borrowing protocol. So the way they make money is off the spread between the borrowing APY and the depositing APY.
Sure.
So Aave doesn't need any money of their own. They just allow people to borrow funds based on what other people have put into the pool. And then they charge those people interest, which they use to pay the interest of people who have deposited funds. So right now, if we look at like the DAI market, you can see that there's kind of like this much, there's 180 million DAI, and this is another stable coin. There's 180 million DAI available to borrow and 713 million that's already been borrowed. And Aave will dynamically change the interest rates for lending and borrowing based on how much is being utilized in the pool. So if people put in, tons and tons of a coin and no one's borrowing it, the interest rate for both is going to be really low. But if it's like super high utilization, then the interest rates are going to be really high because they want people to stop borrowing it and they want more people to deposit it. So what you'll often see in bull runs like we're having today, where Bitcoin just hit a new all-time high and everything, is so you can see Tether's utilization is like totally redlined. Like they barely have any more Tether to lend to people. It's at 94%, which is why it's currently paying, what did it say? 22% interest.
22% interest. So it's all, putting it in terms of like maybe something that we're used to, which is like fixed or variable rate mortgages.
Yes.
A lot of these would be considered, they're variable rate, right?
Yes, so completely variable rate.
And it 24/7 changing. So you may get 22% for one day, and then it would change to, if the dynamics shift and people want to store more money and get more of a return on this, it might shift down to I don't know, have you seen a range? Like this seems pretty high. 22% seems pretty darn high because we're having a crazy run. Yeah. Does it give you any historical averages? Like what's the lowest that you've seen it at?
I've seen it be down at like 2%. The historical ranges don't go back super far here, but you can see...
It was at 3% there, yeah.
Yeah, it was like 2-3% for DAI earlier into September. And then, once the market starts going crazy, it picks up a lot.
Yeah, interesting. So, and just to clear this, so people are they park their stablecoin there, and it makes sense because they want to get a return from it, right? On the flip side, why would people borrow? Is it to go buy more crypto?
Yeah. So you can actually see that's what I've done here is I have about $60,000 worth of ETH deposited as collateral, and I have about $26,000 of stable coins borrowed against it. And the reason I did this was I angel invested in a couple of startups that were taking crypto as their angel investment funds. And I didn't want to sell ETH to invest in them because when I invested in them, ETH was at like $3,000, and I was confident enough that
a pump.
Exactly. Yeah. I was confident that we were going to hit, this period that we're in right now where it would start going up again, and I would really regret selling at $3,000. So instead I borrowed USDC against my Ethereum. And then once the price of Ethereum hits like 6K or something, I'm going to start selling some of this to pay off this debt.
Interesting. Okay. And again, so it's variable, right? So what you are paying what you're paying when you took it out, the rate that you were paying was, I'm guessing, is different than it is today.
Much lower. Yeah. I don't like logging in and seeing that I'm paying 26% interest on my USD, but it's, even that could be worth it though, if you're confident that like the value of what you're borrowing.
Well, I mean, the reason you're paying so high is because there's a lot of like excitement in the market and it's going up.
Yes. And, going back to something I mentioned at the beginning about having access to tools that, were not super available to most people in finance, anybody in the world can access Aave, right? Like you could be living in, Yemen, which doesn't even really have like a whole central banking stable currency, whatever. And you could log in here, you could deposit ETH, you can borrow USDC against it. And I mean, like I can just hop in here, plug in 10,000, hit continue, accept the APY, and then like I just have to confirm this in my wallet, and I'm gonna have that 10 grand in my wallet in like a minute, right?
Yeah.
Like you can, if you're in the US, you can do this with like a portfolio line of credit, but you've got to like email your banker and like fill out paperwork and plug in your social security number and you have all these crazy hoops you have to go through. With this, you're done in like 10 seconds and you've got the funds in your wallet. And I could send that USDC to my Coinbase account and cash it out to my Chase account if I needed to, right? So it's really like that's a simple example of how this really changes the game for what you can do with your money compared to being just like locked in TradFi.
And I think in both ways, right? It's like the Wild West in the sense that a lot of the safeguards are gone. And a lot of the upside is there. So we're in a position where our traditional finance system, if you look at the traditional finance system, unless you are invested in equities or real estate recently, you're getting basically no return on your cash, on your capital. And I mean, there's other things you can be invested in, but you need to be in pretty speculative stuff to be able to get a return to offset the cost of inflation on your. This is really, really interesting. And I can see why it's so like why you saw it and you're like, this is fascinating and why I need to dive more into it because times are changing. A couple questions on this. So stable coins. Mm-hmm. What is the difference between a fiat collateralized coin and a crypto collateralized coin? Because I think we've been talking about fiat collateralized coins, right? Like Tether, USD.
Yes. So that's kind of like a big topic of discussion now because you have fiat collateralized stablecoins, which I'd really only say USDC is right now. Tether claims to be.
Tether has, this is what I want to get into a little bit because there's a lot of news about Tether right now.
Yeah. So Tether's interesting because they always said they were backed by US dollars, but they have a market cap of 69 billion. Yeah. And if they actually had 69 billion in a bank account, they'd be the largest holder of US paper in the world. And it's pretty clear that doesn't exist. And the more people have dug into it, the more it seems to be that they're holding like a certain amount of paper and treasury bonds, but also I guess they had like a lot of money in Evergrande or whatever that big like real estate developer in China was. Like there's a lot of questions with how Tether is collateralized. Whereas USDC, they were originally 100% cash in the bank. They went off that briefly, but now they're going back to being 100% cash in the bank. I think because they want to, I think they're going to work with the SEC to be the like US government endorsed stablecoin. It seems like that's the direction they're going in, which like, I'm super in favor of because like the government hates stablecoins. And so if a good one can be like given the thumbs up by them, that's going to be incredible for the industry. So,
and why does the government hate stablecoins?
It's sort of counterfeit money. Right? Like if you think about it, it's basically saying like, here is this thing that's as good as a US dollar and you can spend it just like you can spend a US dollar.
And you can get a return on it that's much superior to the return you get at a bank.
Exactly. So it really like undermines the whole US banking system because it says, hey, this thing is better than US dollars. You get more yield on it than you get in your normal US dollars. And you actually don't have to like involve the government at all. We're just going to make it for you. And so they're like not super happy about that.
Sure.
But then you've got crypto backed stable coins. And these we can break down into like two categories of over collateralized and under collateralized. So a crypto backed stable coin is one that is not backed by dollars in the bank. It's backed by cryptocurrency. So if we look at the top stable coins, DAI is, so it's up at 31. It's got a market cap of about 7 billion. DAI is the biggest crypto native stable coin right now.
Okay.
And with DAI, the way it gets created is it's through this protocol called MakerDAO, where you can deposit certain crypto assets, primarily like ETH and wrapped Bitcoin and like some Uniswap liquidity or Yearn tokens.
I'm going to ask what wrapped Bitcoin is. If it's too much of a thing to dive into, we can skip it.
Not too much anyway. Wrapped Bitcoin is an Ethereum native version of Bitcoin.
Okay.
So basically, like if you have a bunch of Bitcoin sitting on your like wallet, and you're thinking like, okay, I believe in the long-term price value of Bitcoin, but I don't think that but I also think that Ethereum is like a safe network. You can send your Bitcoin to a service. I can't remember the name of it right now. And then they will in turn send wrapped Bitcoin to your Ethereum wallet. So then you have an Ethereum token that is worth 1 Bitcoin, or whatever percentage of a Bitcoin. And it's nice because it gets used a lot in like lending and borrowing. You probably noticed it was on Aave too. And like the wrapped Bitcoin deposit is like super low, but there are other services. So these guys like specifically focus on earning yield on Bitcoin. And so you can like
Badger Finance.
Yeah, Badger Finance. So there's different like Bitcoin pools, but a lot of them earn like, 1.5 to 30% on your Bitcoin, which is like kind of insane. Or you have like this pool where you're exposed to Ethereum, Tether, and Bitcoin. And so it's kind of like hedging. It's like a 30% hedge against the crypto market, but also like some downside protection. And this pays like 36% in APR, which is like really nice. But anyway, so Bitcoin is just, or wrapped Bitcoin is just Bitcoin on Ethereum.
Okay, cool.
And so you can come to this site, Oasis, which is run by MakerDAO, and you can say like, okay, I want to borrow against my ETH. This is a hardware wallet. Everybody should use one. Once you get into crypto stuff, don't just stay on MetaMask because it's risky. The downside is it makes doing everything a little bit of a hassle. So one sec. So basically what Oasis is going to let us do is deposit our ETH. And then based on the current market price of ETH, we can borrow and technically mint a certain amount of DAI against it. So we say like, all right, if we put in 10 ETH and, okay, it's not gonna let me do it because I don't have it in my wallet, but you can then say like, okay, if I'm gonna put in, some amount of ETH, like how much DAI do I want to kind of like borrow against it? And
DAI, DAI is a stable coin.
It's a stable coin.
But it's backed by crypto.
It's backed by the collateral that has been deposited into MakerDAO and stuff.
Okay, so it'd be backed by like the collateral of other people's ETH or other people's wrapped Bitcoin.
Exactly.
Okay.
And
so interesting. So it's like it's looking at its stability from the saying like Ethereum and wrapped Bitcoin, or even Bitcoin or not Bitcoin.
Just wrapped Bitcoin. Just
wrapped Bitcoin or Ethereum. That's going to be around long enough, and it's not going to be changing. So we can use that as the backing currency for our lending.
Exactly. And you can see that there are these minimum collateralization ratios. So if you deposit ETH, for this one, and mint DAI against it, the minimum collateralization ratio in this case is 170%.
And we say minting, is that creating new, what do you mean by minting?
So this is kind of like how DAI gets created and destroyed. So like USDC gets created and destroyed because in Coinbase, you can convert your like US dollars in your Coinbase account into USDC. And whenever you do that, Coinbase just like creates more USDC or destroys USDC based on which one you're doing. They don't actually always create and destroy. Sometimes they just like send it back and forth, but that's the gist of what's going on. Whereas with Oasis and MakerDAO, when you deposit your ETH to borrow against it, the borrowing process is like creating new DAI that goes into the ecosystem. So if you say, I'm going to put in, $10,000 of Ether and I want to borrow $5,000 of DAI against it. Oasis creates 5,000 DAI and sends it to your wallet. And then the way you get your ETH back is by sending in 5,000 DAI to pay off your debt and unlocking your Ether as collateral.
Interesting. Okay.
So the value of DAI is its stability is maintained because everybody knows that one DAI is always going to be worth $1 of debt on MakerDAO. And so you're always going to, like, the minute somebody sees DAI for sale at like 99 cents, it makes sense to immediately buy as much as they can because they know they can always sell that to somebody for $1.
Sure.
And if DAI is over $1, if it's like $1.01, it makes sense for everybody to sell any DAI they have because they know they can always like buy it back at $1. And the nice thing kind of with this too, in that sense, is when somebody, so say you did the most aggressive borrowing against your ETH. So in this case, let's say I wanted 10,000 DAI, I would need to put in $17,000 worth of ETH based on this collateralization ratio. If ETH's value starts to tank tomorrow or something, the way that all of these protocols work, and part of what also, made me so excited and bullish about DeFi, is it just automatically liquidates the loan. Like in a second, the minute your debt is underwater, the protocol sells your debt to a liquidator at like a small discount, and then they get a free like 3-4-5% by paying to pay off your debt. And the cool thing about that means that when there is a huge market crash, these protocols don't become insolvent. They're not stuck holding a bunch of like underwater debt where they need to get bailed out by the government or whatnot. So when you look at like what happened in 2008, 2000,
that have on the person who was looking for the loan.
Well, you might log in and discover that your money's gone, right? So, if we go back to my Aave account, I have this health factor of 1.88, which means I'm like close to having twice as much collateral as I need for the amount that I have borrowed.
Okay.
So that's like super healthy. But if this were like 1.02, I'd be really close to not having enough collateral for my debt, which would mean as soon as that ratio gets below 1, somebody could come in and buy off part of my debt. And then next time I log in, I might only have like 12 ETH instead of 14.5. And some of this debt would be gone too, but I would have gotten a really bad deal because Aave paid somebody to cover my debt to protect them.
Sure.
So what was kind of cool, if we look at like, the Ethereum 1-year chart and you look at this huge crash that happened in May. This was
in May it went down from a peak of
4,100 to 2,100. So it's a 50% drop in 4 days.
Yep.
Like it's a massive event.
Which is honestly pretty standard in the crypto sphere, right? Like 50%.
Not that much, not for a Bitcoin.
Well, okay. So 30% though is.
Not in a day. I mean.
Oh, not in a day, but in a.
Yeah.
Okay. So there's been, I remember many Bitcoin crashes where it's like just sheds 30 to 40% over a period
pretty
of
quickly.
2 days.
Yeah. No, that's fair. But what was cool was that even though tons of people were, borrowing against their Ether and stuff on Oasis and Aave and everywhere else, they all just got immediately liquidated on the way down. And so even though it was like a 50% market drop, none of the DeFi protocols were like negatively impacted because their automatic liquidations just handled everything and they never like became insolvent. So that was pretty cool to see too, because whenever a massive market crash happens in TradFi, like the banks usually have to get bailed out.
We say TradFi, that's traditional finance.
Yeah,
right?
Yeah. So, it's like with the housing crisis, right? You can't immediately liquidate a house. Right. It doesn't, sure. If the housing market's crashing really quickly, you can't just market sell your house in a matter of seconds, but you can do that with crypto. So they're able to just like handle all of that on the way down. And so that's kind of the risk you're taking if you borrow against your assets with any of these, is if there's a sudden market crash and you were pushing your borrow limit, like, you're going to have a bad time.
And when you say you're gonna have a bad time, like what would happen? So if you have, just say, at 4,000, when you get liquidated, they just take the difference, or what exactly happens there?
Yeah, they usually take the difference plus a penalty amount. Liquidation fee, 13%. Yes. So
you'd lose 13%.
You lose 13% in addition to the amount of your collateral that's lost to cover your debt. So say you had like 10,000 ETH and they needed to sell, or you had $10,000 of ETH and they needed to sell $1,000 of ETH to cover your debt.
Yeah.
They would actually give that person $1,300 worth of your ETH to cover your debt as a way to incentivize other people to buy your bad debt.
Sure. Makes sense. Yeah. So basically, and that's what you're talking about, that with the health score and your ability, like if you have, say you put $10,000 in and then you borrowed 10,000 against that, and then the price of Ethereum goes down 50%. At that point, now you've put collateral of 5,000, you only have $5,000 in and you've borrowed twice as much. So then it would have to liquidate half of your position.
It would liquidate. Well, yeah, I mean, so you couldn't really borrow 10,000 against 10,000 in the first place, right?
Okay.
But so like every asset has the
amount you can borrow on it, right?
Yeah. So like for USDC, the maximum loan to value is 80%, right? Okay.
So it'd be more like, and you have to maintain that ratio. It would liquidate everything below that.
Yeah. So the max to let you borrow is at 70%. And then if you get above 75%, you start to get liquidated. Okay. Yeah.
Interesting. Okay. So that starts to make sense. It's like, all right, you could be in a position where that's a little bit of the danger in doing this, in borrowing from this, is that you're in this volatile market where it's you get a easy loan that happens very, very quick. If it continues to go up, it's great because, well, the amount that you have as collateral versus the amount that your collateral can actually increase, and then it's a smaller loan. But on the downside, it can be liquidated and you can lose a good chunk of your investment.
Yeah, exactly. So it's risky, right?
I think this is really good. Hopefully we covered a lot of this because it's interesting. It's a little bit nitty gritty and technical, and I would recommend if you're listening to it to watch the YouTube as Nat's showing some of this stuff here. A couple questions here, and we'll get a little bit more big picture. But a couple of things here. So when we're talking about the term yield farming, what exactly is yield farming? Have we talked about it? What's different about yield farming or the same about some of the stuff we just talked about?
Yeah. So yield farming is kind of like it's like the active ROI chasing semi-day trading of DeFi. So as a simple example, right, like let's say that you've just got some ETH in your Coinbase and you said like, okay, I want to earn the max yield on my ETH. And what's kind of interesting with crypto is you have these like dual forces of price appreciation and then yield. So price appreciation is going to be what you're more familiar with from like normal stocks, where it's like, okay, I hold my Facebook stock and then my Facebook stock goes up in value, and that's like my price appreciation. Yield farming is basically like being able to say, okay, my Facebook stock is going up in value, but then I can also put my Facebook stock here and it will earn me more Facebook stock. So not only is my Facebook stock getting more valuable, but I'm getting more stock on top of my stock, which is also getting more valuable.
To me, it's honestly a little bit similar to like getting dividends and then reinvesting the dividends.
Yeah, that's a good analogy. Exactly. So, yield farming is basically just saying, okay, I have this crypto asset and now I want to find how to get the highest yield on that crypto asset. So let's just take, ETH as a simple example, right? You've got a couple of ETH in Coinbase and you say like, okay, I want like the max ROI on it. So, you might first look at these like borrowing platforms like Aave and say like, okay, we're looking at like 1.8% on Aave. That's not super compelling. What about Compound, which is another lending platform like Aave? Say, okay, gosh, it's only like 0.1%.
Compound is a lending platform, same sort of thing.
Yeah, same as Aave. So look here and you say like, oh God, like 0.1%, that's basically nothing, right? That's not very exciting. So we're not gonna put it here either. Like what about, Rari dot, is it Rari dot capital finance? Yeah, there we go. Like, let's go look here. This is another type of like borrowing, like lending and borrowing protocol. You can say like, oh, okay, like what if we like, oh, this isn't it. We can go to Fuse and we can say like, all right, which of these are taking
Are these liquidity pools?
These are lending and borrowing pools.
Okay.
So you can deposit any of these assets and borrow any of these assets against them.
Sure.
But you can see like ETH in this one is zero. Yeah, zero. So that's not very exciting.
And again, that's probably the reason is because we're in like a massive bull market, right?
Yeah. And there's more demand for other assets. People probably aren't borrowing as much Ethereum as they're borrowing stablecoins because they expect the value of Ethereum to like shoot up.
Sure.
So they don't want to be holding ETH debt. They want to be holding like USD debt. But okay, like here it's earning 5%. Like it's a little more interesting, right? So, maybe you would put it here, but then you could say, okay, these are all just like lending options. And lending is nice because it's a little more stable and secure, but it's usually not going to have as high of yield. So then we get into, okay, well, what if we put our ETH into a liquidity pool? And a liquidity pool is basically you helping other people trade between tokens. So one, simple example is there's this protocol called Lido. And Lido is for Ethereum and Terra and Solana staking. So this is what's going to replace the current mining process. It's going to be proof of stake. You can stake your ETH to help secure the Ethereum network, and you can earn about 5% APR on it right now. So
when you say, so I want to go into this because I think this is where like some of the language can be challenging. When you say stake your ETH to support the Ethereum network, what exactly does that mean? Does that mean take it out of your wallet, put it somewhere else so that other people can transfer it back and forth? Or what exactly does that mean?
Basically, the way that the network security is going to work once Ethereum upgrades to Ethereum 2.0 and switches from proof of work to proof of stake is instead of everyone's computers having to solve complex math problems to prove that, they worked really hard to verify the legitimacy of the network, everybody's going to have to put up a certain amount of Ethereum to say like, this is how much or how confident I am in like the accuracy and the truth of my confirmations of the network. And if it turns out that I am lying about the transactions on the Ethereum network, you can take some of this money. So it's kind of like just putting your money where your mouth is and saying like, I'm staking, I'm putting up hundreds of ETH, millions and millions of dollars because I'm a completely honest actor and you can trust that everything that I like compute is 100% honest. And you can do that yourself. So if you have 32 Ethereum, you can be a staker on your own. You can like set it up in your house and do it that way. Or you can deposit your ETH into a decentralized staking pool like Lido, and they delegate the ETH to their staking partners and they handle all of the technical logistics for you, but you still earn most of the upside. Because in return for staking your ETH to secure the network, the Ethereum network is going to pay stakers about 6%. So Lido, a year. So Lido keeps 1% of that, and then the other 4.9% goes back to you. It's a pretty good deal. Yeah. And so you could just put your ETH here, and you could earn 5% on it.
And are there any restrictions? You say the word stake. Does it mean that it's stuck there? Or is it actually being able to move in and out? Like, I guess it's when I think of like traditional finance, it's like some of the things that gives you the better return, some of the returns you get that have can traditionally been the best have been something like certificates of deposit, CDs, that you can't remove your money for a period of time. Is that similar at all in DeFi or in this sort of situation? Or is it, you can move it in and out? It's just, they value it being with them for the time that it's there.
Yeah, it's tricky right now because ETH2 hasn't launched.
Okay.
So if you stake your ETH now into Lido, you can't get it back until ETH2 launches.
Okay.
Once ETH2 launches, I think you'll be able to withdraw it without too much of a delay. There will be some, but I think it'll be relatively quick. But the thing that Lido does that's kind of interesting, in return for staking your ETH, they give you a synthetic, basically like a synthetic token that represents your staked Ether. So it's called ST-ETH. And the value of the ST-ETH is what goes up by about 5% per year. And so
I think this might be something we'll have to get you back on for the next iteration of this. So when where we were at, just because without going too technical, you were going to share that at Lido, you might be able to get a better return on your better yield from than you could get for sharing in one of these lending pools, right?
Yes. So, you could look here, deposit your ETH, get 5%. But Lido gives you a certificate of your deposit called Stake ETH. And if you want to, you can actually go trade your staked ETH certificate for normal ETH at any time.
Interesting.
You can do that on Curve, which is a decentralized exchange, basically. And
decentralized exchange, that's similar in the sense to what Coinbase is doing, but Coinbase is centralized, Curve is decentralized, meaning that this Curve has employees, but it's not.
Like
no, Curve has no employees.
Yeah.
They have no employees. They have people working on it, but no employees.
Yeah, and this is all code.
Yeah.
So whereas with Coinbase, there's like support and an order book and everything. With the decentralized exchange, I've got a pretty good article on how they work that I can send you to include in the show notes. But all these trades are just automated. And if you want to trade between your staked ETH and ETH, you can do it here. And then everybody who is supplying Ethereum and staked Ethereum to this trading pool earns a little cut of your trade. They get these like trading fees. And so going back to the yield farming, you might come here and you could say, oh, if I deposit my ETH into this trading pool so that other people can trade between ETH and stake ETH, I will earn about 3% from the like trading fees plus, what did this say? %3 plus, this is like another 3.25%. So now this is at like 6.2%, which I think is the highest we've seen so far.
Yeah.
And there's no impermanent loss here because these are both worth 1 Ethereum. So you're basically just like putting your Ethereum here and you're going to earn almost 6.5% on it, which is like really good. And then
so we have you brought up a word that I want to talk about, impermanent loss.
Yes.
We have not talked about that yet. What is impermanent loss, and why do you want to avoid it? So
impermanent loss, basically, what's the simplest way to explain this? So when you fund a liquidity pool, you're letting people trade between like ETH and USDC, for example. So like, let's just go to Uniswap.
And this liquidity pool idea, at least the way I think about it, is that if it's like I'm putting in, let's say, 100 Ethereum, and somebody else puts in 100 Ethereum, somebody else puts in 100 Ethereum, and then people can trade. If I want to sell my Ethereum, or somebody else wants to sell it, or actually, let's put it this way, somebody else wants to buy it, they can buy right away without any lag because there's this pool holding the Ethereum. Is that right?
Exactly.
Like collectively. Yeah. So it makes the trading much easier. And you get paid because you are contributing to the liquidity pool.
Exactly. Okay. So you can deposit your ETH into Uniswap or SushiSwap or Curve or wherever, and then whenever people trade on whatever pair you've put your ETH into, you get a small cut of the trading fees. So that's great because if people are trading back and forth between ETH and USDC all the time, right? Like we can probably just look at the volume here. Yeah, I mean, 1.67 billion in trading volume in the last 24 hours on Uniswap. The top token was ETH, which had about 1 billion in trading volume. The top pool was USDC ETH, which had a trading volume of 102 million. So 102 million was traded just on this pair in the last 24 hours. And this pair charges 0.3%. So every trade, 0.3% is charged, and that's split amongst everybody who deposited ETH and USDC to this pool, proportionate to the amount of the pool you deposited. So if you put in $1 million of the liquidity, you would earn 1% of the 0.3% on every trade. So $306,000 in fees in the last 24 hours, you would earn $3,000 basically on your 1 million, which is actually like 0.3% in 24 hours. It's like pretty good. It's actually quite a lot of really good ROI. But the downside with liquidity pooling is when you deposit into a liquidity pool, you receive a token that represents your like staked amount in that pool. And then when you go and you say, hey, I want my ETH and my USDC back, the pool doesn't say, oh, well, you put in this much ETH and this much USDC, so here's that much back plus your trading fees. It says you put in this amount of like the pool, and so here is that much of the pool back with an equal amount of Ethereum and USDC. And so you're not necessarily going to get the same amounts of each that you put back in if their prices changed significantly in the meantime. Because if the price of Ethereum went way down, you're still going to get back 50-50 ETH and USDC, but now you're going to get a lot more USDC and a lot less Ethereum because Ethereum's a lot less valuable now. And the pool always tries to stay at 50-50. And because of just how the curves for the trading works out, the more the price moves between the two tokens, the more you kind of like lose out when it does the conversion. I've got a YouTube video on this that explains it a little bit better than I'm doing right now, but you can also just use this website, DeFi Calcs. This is something me and my friend Adil whipped up to see what it looks like. But let's say you put in $10,000 of liquidity and Ethereum was at $4,000 and USDC is at $1, right? Mm-hmm. And then let's say Ethereum goes to 8,000 and USDC is still 1. If you had just held your Ethereum and USDC separately, you would now have $15,000. Yep. But if you put your Ethereum and USDC into the pool and then you withdraw them at these prices, you're only going to get back about 14,142. And that's basically what impermanent loss is. The amount you're getting back out of the pool might be less than it would be if you held it outside of the pool.
Sure. So the idea with impermanent loss, or the way that when you just described it, it's like you want to avoid, you're putting it into this liquidity pool to get some sort of yield, right? Get a return. But you don't want to have the loss that comes from holding it in this pool to be more than the return you're getting on it.
Exactly. And that's kind of
even debit, like even if there's, not even if that needs to be more, definitely don't want it to be more, but you don't want it to make it so that holding it in this liquidity pool isn't even really worthwhile for you. Because it may, if you lose 5% to impermanent loss and you gain 7%, well, it's still the value of putting it in that pool is not that much.
Exactly. So, you kind of end up having to like develop different philosophies around like how much you think these tokens are going to move relative to each other. Does it make sense to LP or not? And so, that would be like one way you might think about like, okay, do I put ETH into this pool Or does it make more sense to put it into a pool with something it's more highly correlated with, right? So if we look at, say we go back here and look at info and we say, okay, compared to USDC, I think there's gonna be a lot of impermanent loss, but with like Bitcoin, it's a lot tighter. It's a lot more tightly correlated, and I think they'll both move. So maybe I'll put it into that pool, or like Shiba or Phantom or one of these other tokens.
I think the idea of impermanent loss we've covered, and I don't want to go too deep into this because we could probably spend like a while talking about strategies. I got a couple.
Keep pulling me back.
a couple of questions here to kind of wrap this thing up. What do you see as some of the biggest hurdles to decentralized finance being widely adopted right now?
Oh gosh, I mean it's so freaking confusing. I mean, if anybody doesn't know anything about DeFi and kept up with this whole podcast, I'm incredibly impressed. It's like the amount of stuff you have to start to like try to understand. I mean,
the language itself is very challenging.
Yeah, the language is really challenging. It's a lot of new like mental models for finance that are completely strange. Like we didn't even get to any of the really weird stuff like self-repaying loans and like collateralized yield-bearing assets, and like it gets like even crazier from like the stuff we started with, right?
Sure.
And then you've also got to figure out like wallet security and, like auditing opportunities and like figuring out what's out there. Cause there's no like, it's not like a good Google for DeFi like opportunities. I mean, there's aggregators like DeFi Llama is really good for just like seeing different platforms you could use. But I think it's like, when you're thinking, okay, why?
It just feels like it's so early.
Yeah, it's so early, and it's easy to get tricked by the amount of money that's in it into thinking that, oh, this is like super far along. There's already, $200 billion of money in here. There's something like under 100,000 DeFi users, or no, there's something like under 1 million DeFi users. Like that's wild. It's like a very small number of people who are using this. And some of those people have a lot of money, but it's still just so early for a lot of this stuff. And it's, it's not like super easy to get onboarded and stuff, but there are like, if you wanted like some light places to start, the one that I would encourage, people to maybe look at is this one called Pool Together. And you could like put some money into here straight from Coinbase or Dharma pretty easily. Just like install your MetaMask wallet, come to Pool Together. And this is kind of cool because you can just put your USDC in here and you earn 6.5% APR on it.
Yeah.
And you have a chance at winning a $56,000 lottery prize this week. So
smart. It's a really smart way for them to incentivize people to join in this pool.
Yeah, it's like gamified saving. It's a no loss lottery. So if you don't win, you still have all of your money and it keeps earning interest each week, but you've also got a shot at winning up to 56 grand in a given week.
Like the DraftKings, I think a lot about sports betting, right? And they'll do all this type of stuff because you can place sports bets anywhere. I mean, not anywhere, but in a lot of different places. And so they'll put all these different prizes, and it's kind of the same sort of thing here. It's like, let's gamify it to bring people into our pool. It's very smart.
Yeah.
Okay. So if you're a business owner and you've got a traditional business, maybe you're selling stuff, an e-commerce business store, like what are the things that you should care about and be thinking about? Is there anything that you would recommend people do and explore that would help them with either personal finances or their business?
Yeah. So if I had a business that was just like sitting on some cash and I wanted to like put it to work a little bit, I would look at one of two things. The first one is this app called Alchemix. And this is the like self-repaying loan app. And what's cool with this is like, let's say that you had $100,000 in your business bank account that you wanted to like put to work for something, and you wanted to be able to get that 100 grand back really quickly if you needed it, but we're fine with having it earn some yield in the meantime. One thing you could do is you can go to Alchemix, and I might wait until like December to do this because that's when their new platform's coming out. But you could put the 100 grand into Alchemix, and then they'll immediately let you borrow 50 grand against your 100 grand. And then you can send that right back into your Chase account. So you still got 50 grand, but now you also have 100 grand earning 5.5%. And that 100 grand earning 5.5% is paying down the $50,000 you borrowed against it. And you could just go in and withdraw more of that anytime you wanted, like every couple months. And you'd have this like additional line of cash from something like just pegged to the dollar. So it's not going to be super volatile and just like passively accruing more money that you could pull back out to do like random business stuff with. And if you ever needed the other 50 grand back, you can immediately liquidate the whole thing and you just have it in your account immediately. So that's kind of a cool option, right? You could also just like hop in.
When you say the self-repaying loan, is that when you're talking about that, is that it automatically pays back the loan as it goes? Is that what?
Yeah.
Okay.
So like after a year, instead of you having $105,000 on your top line, you would still just have $100,000 on your top line, but you would only owe 44,400 or whatever instead of owing the 50,000.
Sure.
So your debt, you don't owe any interest on your debt. Your debt only goes down based on the yield earned on your original deposited amount, which is pretty cool.
It is really cool.
Yeah, interest-free debt against your collateral, which is like really nifty. Or, just hopping into one of these other stablecoin pools, right? Like if we look at, Convex, which is one of like my favorite platforms, and we say like, okay, here's that like MIM stablecoin again, it's earning 34%. So if you had, and you've got to have like 50 to 100 grand if you're going to do active yield farming because Ethereum fees are so high. You can do it on other platforms. You can do it on Polygon or whatever. But if you had like 100 grand you wanted to toss into DeFi to earn yield, like, you're earning 34% on stable coins right here. Like, it's kind of ridiculous.
It is. And again, that can shift. That can shift, right? It could be 34, could drop down to...
Well, but this has been above 25 for the last like month and a half. So,
wow.
Which is impressive.
You're not going to get that yield anywhere else on traditional finance.
No chance. So you could do like really low effort yield farming where just every week or two you hop in and say, oh, well, actually like this stable coin pool is higher yield now. So I just rotate into that one and then come back in a few weeks and collect your earnings and whatever. And then your cash is like doing something more interesting than just sitting in your bank account collecting dust. So
that's crazy. 100 grand, you make what? 34 grand a year.
Yeah. You'd be making almost $3,000 a month off the passive yield from that money.
Which again, you could cover your, like if you put a good chunk of money in there, it's very possible you could start covering some of your, like your mortgage or some of these fees that you've got. It's pretty cool.
That's sort of one of my goals right now as we enter this bull market is to just build up a big enough stablecoin yield farming position from like selling ETH or whatever else so that it can just like pay for all of mine and Cosette's like monthly expenses and then not have to like worry about income from anything else, just live off stablecoin yields. Like, it's a pretty good deal.
It's a great deal. It's fascinating. Last question here, and then we'll talk a little bit about things you're doing that people can get connected with if they want to learn more about this. But what are some projects that you're excited about? Are there any coins or anything that you're really excited about right now that you have been following and tracking?
Yeah. So the one that we didn't get to that I was going to show you in the yield farming is this project called Tokamak. And they're paying 12% on ETH right now, which is like way higher than any of the other ones that we looked at.
Yeah.
And what they do is they automate yield farming for you, basically. So you just put in a single asset and then they go find the highest yield for it, like slightly different than how Yearn does it. But these guys do like liquidity pools, and they manage impermanent loss risk and like do all of that for you. And then you just like sit back and collect interest. So they're really, really cool. I've got like Alchemix and ETH and like their LP in here. So they're really, really neat, and they're still pretty early. They haven't like gone completely crazy price wise yet. So I really like them. There's this other one that just launched called KlimaDAO. And this is it's a protocol that you can buy their token and you can stake it. And the way that their token works is it's on a really aggressive inflation schedule. So they're constantly printing more of their token. But if you have your tokens staked on their site, your balance is automatically adjusted for inflation. So your value doesn't get inflated away.
Stake it with them.
What's that?
So it's a high incentive to stake it with them.
Very high incentive to stake it with them. And so it says that the APY is like 35,000%, but it's not actually. That's just because they're inflating it rapidly.
Sure.
And so they want you to just stake it here and like never sell it and never touch it. And then what they do with the funds in their treasury from people like buying their token and like selling stuff into their treasury is they go out and they buy carbon credits on the like international market. And then they lock those carbon credits in like a real world, bank account or whatever. And so the goal of this project is to dramatically drive up the price of real world carbon credits to make it cost prohibitive for businesses to just buy carbon credits instead of fixing their pollution issues.
Wow.
So
this is very smart.
Yeah, it's a really cool idea, right? And what they've done too is they have their token called Klima, but then they also created a crypto token that is one-to-one backed by individual carbon credits, a base carbon ton. So you can actually buy base carbon ton tokens. And they're like, what are they, like $10 right now or something? And so if you like did a big NFT launch and you were worried about the environmental impact, you could say, well, we bought and burned, 100 base carbon tons to like offset the environmental impact of like the heavy energy use of what we're doing or whatever. So they actually made a crypto token to represent like carbon credits. It's really neat, right?
Yeah, it's really, really interesting. That's very, 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 this is like where some of the excitement for me comes. It's just getting exposed to ideas that were not really possible before this, right? Like the idea of having a real world impact and locking up carbon credits and then driving up the price of the market to eliminate pollution is a very, very smart idea.
Yeah.
This is awesome, man. Now, this has been really, really, really great. I know people are going to listen to this and they're going to be like, wow, this is interesting. I also need more because it's challenging to get through. I know you have DeFi orientation, which is your kind of step-by-step course for entering DeFi and earning income for your crypto, which we'll put in the show notes. What's the best place though for somebody to get connected with you? And I mean, I highly recommend that if you're interested in this, buy your course because it's what, $99?
Yeah, I think it's only $99. And there's like a few thousand people who've gone through it now, and people are really active in the Discord, which is nice because it's like social and people help each other out. So that's been a lot of fun. I've got a blog, a separate blog that talks about this. If you go to like dfriday.xyz, you can find the archives for that. And then Twitter. Twitter is really just like, that's where all the crypto action is. That's where I'm most active. So definitely just like getting involved there. And if you want like a place to start, I have a list on Twitter. It's like helpful crypto Twitter. I think if you go to my profile and look at my lists, you'll find it. And it's like 60 or 70 people in crypto you can follow to like start to figure out what's going on.
Awesome. I will say, I think, if you're listening to this and you're like, all right, this has piqued my interest. It doesn't take that long if you go through Nat's course, it's going to take a couple hours.
It's like 45 minutes to do the basic part of it. Yeah.
And basically all the stuff that we talked about today, you'll be able to go through kind of in a short chunks and learn enough to be able to go there and feel confident making some decisions around creating a MetaMask, all these different things. So I highly recommend it. Nat, it's been awesome. I learned so much. Like always, every time I talk to you, I'm always learning about usually the things that you're excited about. So thanks, man, for coming on here.
Yeah, thanks for having me. This is a lot of fun. And
yeah, man.
talk soon.
Awesome. I'll talk to you soon.